On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Welcome to 2024. If this is your first week back at work, you have my sympathies. I returned on Monday, and I know it is a hard road after a long break that was very enjoyable. But we're fully back into it now, so we can look forward to a steady stream of podcast episodes. You'll hear from me twice a week. Once on a Sunday or early on a Monday about the week ahead with what we should watch out for in terms of economic releases and what's happening out there across markets. And again, midweek on a Wednesday or a Thursday, usually on a different topic. So this is the first of those episodes. And today I wanted to talk about income investors and how many of them are on borrowed time. And unless they want to face a pretty hefty drop in income, they need to start thinking about making some changes to their financial situation and their portfolio. Income investors have had it pretty good for a long time, at least in recent years. Interest rates have been sitting at the highest level in 15 years recently, and it's become much, much easier to make a steady, reliable income on your savings. Term deposit rates, 6-month term deposits, offering a yield of 6% at the moment. So if you're lucky enough to have a nest egg of, let's say, $100,000, you can very easily generate a monthly income of $500 before tax, which is fantastic and much better than we've seen 3 years ago, 5 years ago, or even 10 years ago. However, term deposit rates do tend to follow the official cash rate, the OCR, quite closely. And that means these attractive rates that are currently on offer are on borrowed time. The OCR is sitting at 5.5%, which is the highest level we've seen since 2008. I think we're at the top. So for me, the bigger question is how long does the OCR stay at these levels and when will it fall? That will be a function of how the economy develops and how quickly inflation slows from here. We had some new inflation data out this week, and headline inflation is sitting at an annual rate of 4.7%, which is much lower than the peak from early 2022, I think it was, of 7.3%, but it's still well above the Reserve Bank's target range of 1 to 3%. Now, I've had a lot of questions from people, or comments, I should say, saying, why are we talking about OCR cuts? The inflation rate is 4.7. That's still quite far away from the midpoint of that target range, which is 2. So how can the Reserve Bank reduce the OCR when inflation is double or more than double what their target is? Now, remember, they don't need to wait until the inflation rate is within that 1 to 3% band before they cut rates. Their remit, their mandate is to keep future annual inflation between 1 and 3% over the medium term. And the Reserve Bank defines the medium term, or at least they have in most of their recent history. The medium term is defined as typically being between 18 months and 3 years. So in other words, they don't need to wait till inflation is below 3% to cut the OCR. What they need to feel comfortable about is that inflation is headed towards that target, 2% or between 1 and 3 over the next couple of years. It's a medium-term target, and it's about getting in future inflation to between 1 and 3%. And the time frame that they're talking about is between 18 months away and 3 years away. So if they're at that point where they're confident that inflation is headed there over that sort of time frame, they can absolutely cut the OCR. They don't need to wait until we've actually seen an inflation print of 2.9% before they can take action. So they're looking ahead. That's really important to keep in mind and remember. We had some inflation data out this week. Like I said, it's the lowest we've seen in a couple of years. It's actually below what the Reserve Bank had in their last set of forecasts, which is good. However, when you look at the detail, the non-tradables inflation, which is the domestic inflation, is still higher than we would like. So all of the weakness, or a lot of the weakness, came from imported inflation, which is overseas factors that are beyond the Reserve Bank's control anyway. So it probably wasn't as good in terms of the fall that we saw. That probably wasn't as encouraging as it looks on the headline. Amongst the detail, there were some elements of stickiness that won't please the Reserve Bank. So it's still a bit of we're not out of the woods yet, put it that way. But look, 4.7 is a lot better than 5.6, which is what it was last time, and it's a lot better than north of 7, which is where it was at not so long ago. So we're absolutely moving in the right direction. And I do believe that this year we will see the OCR decline. The Reserve Bank doesn't have that in their forecasts. We will next hear from them late next month, in late February. They will still talk tough because it's in their interest to talk tough and to keep us a little bit nervous. So you won't see them necessarily agree with what many economists out there are expecting. They will still want to keep people worried about the interest rate outlook because they want our behaviour to remain subdued in terms of spending, in terms of demand, and they don't want people to get too excitable just yet. So I heard one economist say that they will deny, and then they'll cut. And I think that's a really nice way to put it, because that is exactly what they'll do. So you won't necessarily hear them open the door to rate cuts particularly openly when we hear from them in February, or at least I don't think they will. But financial markets are expecting rate cuts, and I think financial markets are right. It's really just a matter of when the timing is. Markets see the first cut coming potentially as early as May. I think today pricing points to a 60, maybe 65% chance of a cut in May. So better than even chance in the eyes of financial markets. That's absolutely possible. However, many of the economists out there, and I think it's 3 out of the 4 big banks, I think Westpac is the one that believes they might wait. But outside of Westpac, all of the economists are picking August. The reason it's sort of May or August and not something in between is because they do their OCR decision, I think it's 7 or 8 times a year, and they do a monetary policy statement. Is it 4 times a year, I think? And the monetary policy statements are a better opportunity to make big changes because that's when they release a new set of projections and forecasts, and that is a much more logical time for them to change tack. So I think it's one of those monetary policy statements that really are the live meetings in terms of a potential change of approach this year. So May or August or November. If I had to put money on it, I'd probably side with the economists, I think, and say that August makes the most sense. But May, look, it's absolutely possible. But we're really arguing about the detail. I think for investors that are looking ahead on any long-term basis, the upshot here is that anyone sitting comfortably in term deposits, getting their 6%, is absolutely facing a declining income stream in the months ahead. So markets expect the OCR to be cut in potentially May, definitely by July or August, and market expectations see it almost 1% lower over the next 12 months. So it's at 5% at the moment, 5.5, I should say. And financial market pricing sees it at close to 4.5 in 12 months' time. And 6 months after that, Some economists' forecasts have it as low as 3.5%. So in 18 months' time, some economists see it at 3.5% compared to 5.5% today. So potentially quite big changes coming over the next 6, 12, or certainly 18 months. So if we come back to that monthly income of $500 that you're getting from your 100 grand that you've put in term deposits, that's safe for now, but it is not far away from the point where it's going to start falling. And this time next year, 500 could have turned into 400, and 6 months after that, it could be headed for 300. So that is a pretty big change in income if that is what you're doing with your money, and if you're living off your savings, or if it's a reasonable part of your income, that would represent a more than 30% fall in income within 18 months. So I guess the key message I have for investors and savers today is that short term deposits are offering great value right now, but don't get content, don't get complacent. Within 6 months, or even potentially less than that, if financial markets are correct, within a matter of months, interest rates could be headed lower. And after the first cut, they're likely to keep going lower. And if that happens, investors, or term deposit investors specifically, will be facing much less attractive reinvestment rates and a rapidly declining income stream, which is something we all need to think about. In contrast, you sit here today and you can lock in a yield of between 5 and 6% from a high quality fixed income portfolio, and you'll have a maturity that stretches out years rather than months. So I think investors would be very wise to take advantage of that opportunity while interest rates are high. You want to make hay while the sun is shining. That changing market dynamic of the OCR coming down and the tide turning, that could have important implications for other asset classes too. The local share market is offering a dividend yield of about 4.3%. That includes imputation tax credits. So 4.3 is comparable with the 6% you'll get on a term deposit, because both are taxable. So that's a pre-tax yield from both of those two options. Now, 4.3 is obviously not quite as enticing as 6% that you'll get in the bank, but I guess the really important difference is that dividend income is likely to grow over the next 2 to 3 years. It's 4.3% today, and it's likely to rise over the medium term, because all of those businesses that make up our share market that are earning profits and paying dividends, if they're doing what they should do and what they've done historically, they will grow those earnings and those profits and those dividends. And your 4.3 is the yield you'll get today, but that will drift higher over the next few years instead of falling, which is what your 6% is going to do. So do you want to have 6% today that's falling, or do you want to have 4.3% or thereabouts today that's rising? That's a key decision for many investors. By the second half of this year, you could start to see money moving back towards those other asset classes as deposit rates are falling. So whether it's local fixed income, whether it's New Zealand shares, property as part of the equation, managed funds, international opportunities as well. All of those things are part of the equation. But I guess the point I'm trying to make is that you've got a whole lot of money sitting on the sidelines, and I think some of that money has got a little bit lazy because it's been a pretty easy gig, hasn't it, in recent months, just sitting back and getting your 6%, and you haven't had to do a whole lot of work. So that's fine for now. But when you fast forward 6 months, 12 months, 18 months, and your 6% turns into 5%, then it turns into 4%, all of a sudden you are going to find yourself having to rethink your investment strategy if you want to maintain that same level of returns, and certainly that same level of income. So you could wait until the very last minute, until we're right on the cusp of interest rates coming down and other assets responding to that. But my advice would be, rather than waiting for the herd to catch on to that changing dynamic, savvy investors should start thinking today about adjusting their approach and their strategy. Do that sooner rather than later. Do that while it's not completely in the price and while the opportunities from other asset classes still look reasonable. That's all for today. Good to talk again. Looking forward to talking very regularly this year. So please share the podcast with a friend. The more likes we get, the more ratings we get, the more people that share it, the bigger and wider group will benefit from these sorts of insights. So thanks for listening, and we'll talk again soon.